have been raising my targets for gold. I'm up to 7,000, and I'm confident that's where we're going. Gold is the current buy the dip asset, and the stock market isn't. I would say the average margin for a gold miner is about $2,000. The only time that Wall Street is interested in mining stocks is, again, mining stocks aren't really investments. They really are speculative investment. Their value of the mining stock is 80% based on the price of gold and silver. So you're basically betting on that commodity price. So silver just comes along for a ride. Plus, gold is mainly a store of value asset, whereas silver is primarily a fabrication commodity asset. As far as use for monetary metal, it's very, very small. And so that's how it becomes a monetary metal. People will go buy physical silver as basically a proxy to gold. They'll tell you the bond market is absolutely stable. Well, guess what? Hank Paulson came out yesterday in an interview and said it isn't. We got to be really careful. It's different this time. He's basically warning you that the bond market is basically approaching a crisis moment, which is the reason why gold's going higher. I think that the wind is at gold's back, that gold is the current buy the dip asset, and the stock market isn't. Even though the stock market just did, another V-shaped recovery, I still don't think it is the buy the dip asset. I think this is inevitably people are going to get hurt, I think, in the stock market. Now, I could also be wrong, and people would get hurt in the gold and silver. I do consider myself a speculator, not an investor. So gold and silver is all about belief. It really is. It's not about fundamentals. Gold and silver, look at gold. I mean, from 1980, 82, 81 until 1999, almost 2 decades, gold did nothing, absolutely nothing. $250. I mean, it was $850 in 1980, and then it was $250 20 years later. So, gold and silver can absolutely be brutal investments. That's why I'm a speculator. My portfolio was down 70% in 2008. 2008 it was down 70. So you can get, most people can't handle that kind of volatility. And so the mining stocks, but you could do the physical metal. I think the physical metal have done extremely well. I mean, since 2000, silver's went from $250 to $4,800. So gold's done pretty darn good for 25 years. Really, really good.
What sounds like conviction here is really a warning about how quickly investor psychology can replace discipline. As Don Durrett points out here, gold can protect capital in certain cycles, but he also admits belief often drives these markets more than hard valuation. That matters because many investors forget gold spent nearly 20 years going nowhere after 1980, while stocks kept compounding elsewhere. His reference to a 70% drawdown in 2008 is the part many bullish interviews leave out. Next, Don Durrett discusses why today's move in gold may be different from past cycles that punished impatient holders.
Now the question is, will it continue to do well? I think so. I think the wind is at gold's back here. And I think that for me, I have been raising my targets for gold. I'm up to 7,000, and I'm confident that's where we're going over the next 2 to 3 years. And if I'm right, then the miners are going to be, have that leverage of those higher prices. The miners already have high margins. I would say the average margin for a gold miner is about $2,000. So we're about $4,800. So, you're looking at $2,800 for all in. So about $2,000, somewhere around there, $1,800, $2,000 margins. Those are very, very high margins, considering gold was $2,000 in early 24. So the margins are as high as the gold price. So the margins are high already, and I think they're going to go higher, which is amazing. So the gold and silver miners are slowly, it hasn't happened yet, but they're slowly and steadily going to become something that gets on the radar of Wall Street. Right now, Wall Street doesn't want to own the mining stocks, and they're basically all very cheap still, but I think they will. And what that will take is a fear trade, and we haven't had that.
The bigger story here is not the gold target, but the margin expansion hiding underneath it. As Don Durrett points out here, miners are already earning unusually strong spreads even before another major move higher in bullion prices. If gold stays elevated through 2026, investors may start revaluing miners based on cash flow instead of simply treating them like speculative trades. The market often ignores a sector until institutional money sees earnings growth it cannot dismiss. Next, Don Durrett talks about why mining shares still behave more like risky speculation than traditional long-term investments.
The only time that Wall Street is interested in mining stocks is, again, mining stocks aren't really investments. They really are speculative investment. The reason why is because the value of the mining stock is 80% based on the price of gold and silver. So you're basically betting on that commodity price, and things can go wrong. Every single company can run into problems. These aren't the Amazons of the world that just continually grow. These are companies that can run into problems. Any of them. You can't pick winners. I say that you can't pick winners with mining stocks. You can pick potential winners. And so gold and silver prices, I think, are going higher. Now, silver just follows gold. Gold is the big, massive market. It's probably the highest traded market there is. So from a percentage point, valuation point, silver's tiny compared to gold. So silver just comes along for a ride. Plus, gold is mainly a store of value asset, whereas silver is primarily a fabrication commodity asset. As far as use for monetary metal, it's very, very small. Silver is basically a commodity, but it becomes a monetary metal because people can't afford to buy gold. How many people can go and pay $4,800 for one coin, right? I don't have $4,800, but I want some gold. Well, I can buy paper gold or I can buy some physical silver.
Most investors hear mining stocks and assume they are buying exposure to rising metals with simple upside. As Don Durrett points out here, roughly 80% of a miner's value can be tied directly to commodity prices, leaving investors exposed to operational mistakes they never see coming. That means even if gold rises, poor management, jurisdiction risk, or cost inflation can still destroy returns. His distinction between gold as wealth storage and silver as accessible monetary metal is more important than many commentators admit. Next, Don Durrett unravels what is actually pushing investors back toward precious metals in this cycle.
And so that's how it becomes a monetary metal. People will go buy physical silver as, it's basically a proxy to gold. And so you mentioned a little bit about macro in this, so I need to talk a little bit about the drivers for gold. The reason why gold has risen since early 2000, $2,500, more than doubled in value, is because of only one reason. And most people don't know this. Some of you do, some of you don't. But the reason why is because of the combination of the geopolitical uncertainty around, who is the U.S. the top dog here? Does the U.S. set the rules for international trade? Do we use the dollar? Do we need to hold U.S. treasuries? There's all this uncertainty, and people are selling treasuries and buying gold because of that uncertainty. But the other thing that's probably more valid is the uncertainty around the U.S. bond market. As the debt has gotten bigger and bigger and bigger, now it's up to $39 trillion, and we're paying $1 trillion a year in interest. That bond market is literally the heart of the U.S. economy. And if that bond market it becomes fragile in any way, gold is really the only place to hide. And so people are nervous about the fragility of that bond market. Now, if you listen to Wall Street or you listen to any economist, they'll tell you the bond market is absolutely stable. Well, guess what? Hank Paulson came out yesterday in an interview and said it isn't. He said, we got to be really careful. It's different this time. He's basically warning you that the bond market is basically approaching a crisis moment, which is the reason why gold's going higher.
The real issue here is not inflation alone, but fading confidence in the system that prices everything else. As Don Durrett points out here, investors are quietly watching sovereign debt markets because that is where trust can disappear faster than stock traders expect. With US debt near $39 trillion and annual interest costs around $1 trillion, gold is increasingly being treated as insurance instead of speculation. Wall Street still frames bond markets as stable, but that narrative is starting to crack. Next, Don Durrett discusses why political stress may now matter more than economic data.
And so the political problems are probably more important than our economic problems. But if you look at our economic problems, they're severe. You have a stock market that's at 230% of GDP. So it's uber overvalued. It should be it's 100% overvalued. And Dave Collins says it's 200% overvalued, which if it's 100% overvalued, you'd have a 50% correction. And I don't know if we're going to do that, but it's highly overvalued. If you look at the PE ratios, the forward PEs, they're at near historical highs. And then if you look at the weakness in the economy, it's a long list. The employment, for instance, if you lose your job today, when economy is good, it usually takes 3 months to replace your job. Today, you're lucky if you can replace it in 6. And college graduates today are having a really difficult time finding a job. Even the best ones, like Stanford put out a thing, their grads are having trouble finding jobs. So even the elite schools are having trouble placing their students. So the economy, from an employment standpoint, is not strong, if you will. There's headwinds there. And then we have high interest rates, which are going to stay high the rest of the year. So that's headwinds there. And then, the debt bubble, we're paying $1 trillion in interest and we keep rolling over the debt.
Markets can look healthy on the surface, even while the underlying economy begins to weaken. As Don Durrett points out here, valuations near 230% of GDP suggest investors may still be paying premium prices for slowing growth. At the same time, hiring softness and elevated rates are creating pressure that quarterly earnings headlines often fail to capture. When replacement jobs take twice as long to find, portfolio risk becomes more personal than theoretical. Next, Don Durrett talks about how individuals should prepare when financial strain moves from markets into everyday life.
We have to borrow about $10 trillion over the next 12 months. Hank Paulson just came out and said that this is a crisis in the making. We need to start planning for this crisis, right? Everything is coming to a head, if you will. I firmly believe that there's no way out here, that, again, Washington is going to become a museum because the political system is broken, which is going to break the economy, and there's no solutions. Buy gold and silver.
Right. No, I appreciate that answer, Don. And it makes me actually want to stay here in terms of now the financial direction. If we take a step back, our governments are not taking care of our financial stability. What about all the individuals? If we look at more than half the population are paycheck to paycheck right now, right? So we have a government that's not taking care of itself financially, and then we have a lot of people that are living in fear right now. So I would love to get your opinion on, you've been seeing this for a long time now. You've been preparing. And I think the first thing that is so undervalued before anything is education, right? Once we have knowledge, we're able to then protect, hopefully, ourselves by learning and applying the knowledge to make good decisions. So I'm curious to get your opinion on, if you were to walk someone through right now, how to prepare for this.
The number most people will miss here is not inflation, but the sheer pace of new borrowing. As Don Durrett points out here, adding $10 trillion in debt within 12 months signals a system being held together by refinancing rather than stability. When over half of households are already living paycheck to paycheck, sovereign stress eventually spills into personal balance sheets, whether markets admit it or not. The deeper issue is that financial literacy becomes survival when public institutions stop acting like responsible stewards. Next, Don Durrett discusses what a practical financial defense strategy could look like for ordinary investors.
I know you just mentioned about gold and silver, but before going there, how would you advise to someone that was tuning in right now, their first time hearing Don Durrett speak about the financial world?
Well, from a financial standpoint, I firmly believe that there's like 5 assets that you want to own financially. So first one is physical gold, physical silver. Is you can decide which one you like better. You want to do half and half. The next one is crypto, which is I think that Bitcoin and Ethereum are not going away. Now you don't have to do 5% of it, but in the old days we used to talk about 3% of gold, physical gold. But I think that those 4 assets are foundational, I believe, for me. I want to own all 4 of them. And the 5th one is some type of a currency, right? So, and that currency, you can break it up into pieces. You could do some dollars, you could do French francs, or you could do some other fiat. The other one I think is stable coins. So in that 5th pillar of, okay, what money am I going to keep? The other 4 I consider as assets. You know, I don't consider crypto as money. I consider it as an asset, like gold, silver, Bitcoin, Ethereum. Those are assets.
Diversification sounds simple until you notice how differently each asset behaves under stress. As Don Durrett points out here, he separates money from assets, which is a distinction many retail investors never make until volatility forces that lesson. Gold may protect purchasing power, while crypto can offer asymmetric upside, but neither responds to the same macro pressure at the same time. The overlooked point is that currency exposure itself can become a risk when central banks shift policy unexpectedly. Next, Don Durrett talks about why ownership structure matters just as much as the asset itself.
So instead of holding stocks, if you will, I would prefer just to hold those assets. And you can pretty much own them without counterparty risk, I believe, other than the internet. Now, the fiat, the currency, you can break that up. What currencies am I going to have, that 5th pillar? But I think stable coins are going to be important. I think I'll hold some of those. I'll probably hold some dollars. I'll probably hold some Swiss francs. So those are kind of the 5 pillars of financial security, if you will. I would say that if you don't have 1,000 ounces of silver, that you should start stacking. If you only stack 10 ounces a month, that's going to take you only going to get 100 ounces in a year. So it's going to take you a while to get to 1,000 ounces. Now that we're almost at $100, so it's like 100,000, right, to do it. Used to be, $25,000 to get 1,000 ounces, but now it's getting more expensive. But I think that if you have 1,000 ounces of physical silver or gold equivalent, that's a really good piggy bank. So from a financial standpoint, that's kind of what I think is a good approach, if you will.
Counterparty risk rarely matters to investors until trust suddenly disappears. As Don Durrett points out here, his focus is not just on what you own, but whether someone else controls access to it when markets cease. That is why physical assets appeal to cautious investors who remember banks, brokers, and payment systems can all become points of failure. His 1,000-ounce silver benchmark may sound extreme, but the underlying message is really about disciplined accumulation over time. Next, Don Durrett unravels why he remains deeply skeptical of traditional stocks and bonds going forward.
I don't trust stocks and bonds going forward. Today, even today, I have trouble. I do gold and silver mining stocks, but I plan to sell them. I plan to get rid of all of them in this bull market because over the long term, I think they have too much risk. But in the near term, I'm okay with them. But you have to be really careful. I think careful with stocks and bonds because the financial system right now is not stable, I don't believe. And so now there's the other way that you want to prepare for the changes, right? The change that you're coming into. That's very difficult. I have for instance, my approach that I do, I don't think it works for everybody. And so I don't really want to share it in this environment because, half of the audience, that's probably not going to be appropriate for them. And so the one thing that I would say though is, be prepared to move. wherever you're at, be prepared to move. Don't think that this is where I'm going to stay. This is where I'm going to stay for the rest of my life. You'll be surprised why. But put it this way, you want to be open to change. Let's say that you're going to be open to change, but everybody should think in terms of, I might have to move. And if I have to move, where would I move to? I think that's going to be relevant for 75% of the people who are watching us over the next 10 years, for instance.
Sometimes the strongest warning is when someone bullish still talks about an exit plan. As Don Durrett points out here, even sectors he favors are positions he intends to sell because long-term systemic instability changes how risk should be measured. Many investors still treat stocks and bonds as permanent foundations without asking whether that old framework still fits a debt-driven market. His point about mobility is less dramatic than it sounds, because financial pressure often reshapes where people can afford to live. Next, Don Durrett discusses why adapting mentally may matter more than predicting markets perfectly.
I think a lot of people are going to be moving that don't expect to move. And I think so. That's one thing I think a lot about. And I don't really care where I'm going to move to, but I'm cognizant of the fact that I'm probably going to move somewhere. So you have to think in terms of willing to move, willing to change. I always say that don't hang on to the present. Don't hang on to your current lifestyle. Be ready to lean into change. I think that's going to be a lifesaver for a lot of people. Lean into change. In other words, don't expect the past to keep going. Our standard of living, what we expect, how things are, don't expect that to continue. And when it doesn't, don't get upset. Just lean into the change.
The hardest portfolio adjustment is often psychological, not financial. As Don Durrett points out here, investors who stay emotionally tied to old assumptions can struggle more than those with smaller accounts but greater flexibility. Markets have always rewarded adaptation, especially after major policy shifts or economic resets that change living costs and opportunity. His message is really about accepting that preserving wealth may require changing habits before circumstances force that decision for you.